Here we are at the sponsor directory. Like I said, you can sort by minimum investment, strategies, property types, risk profile. Anyone who has an open opportunity, you can click there and they will show up. And then next, I will show you the verification requirements. There's verified gold, which Chris and Brock are. And then there's Verivest verified. So Verivest verified is the minimum verification for people to be a part of our platform. That means no felony convictions, no unfavorable resolved lawsuits, no personal or business bankruptcies, things like that, no regulatory sanctions. So all those things are the baseline to becoming Verivest verified, as well as signing the code of conduct. So here we are at Kirkland Capital Group, who we have here with us today. They're a private lending firm, and you can see that they're 100% monitored, which I'll go into what that actually means. But Verivest Verified Gold means that they are following the rules of the deal's operating agreement and allocating the money how they said they would. So this is the highest level of transparency. So look for the gold check, and you will make sure you are working with a sponsor that has no issue being transparent with you. So let's move on. So the sponsor track record, this is another thing that sponsors can engage us to verify for them. So here's, we have the loans up from Kirkland Capital Group. Actually right now, this is just a screenshot. So you can go on Kirkland Capital Group's page on verivest.com and see all of their loans, which is awesome, and the loan amount, and there's a bunch of other little interesting attributes that you can see on there as well. So if you would like to, the Verivest Community Network is a network where you can connect with other people in the real estate industry, connect with sponsors, connect with other investors, ask questions, join a webinar, opportunity webinar, or an educational webinar like we're on today. So if you want and are interested in that, you can scan the QR code on the screen that you see there, or you can just type in the hyperlink below. All right, so without further ado, we are going to introduce the guest for today. We have Chris Carsley. He is the CIO of Kirkland Capital Group with over 25 years of investment industry expertise. While he has more than 23 in real estate alone, banking, private equity, and principal investing experience. Let's move on to Brock. Brock has been in the real estate finance industry since 1990 with roles in underwriting, construction, origination, and technology. I also think it's fascinating that Brock has expertise in international experience in Hong Kong and Taiwan. So that's also a really cool fun fact about Brock. I will let them explain a little bit more about themselves. So I'll let you guys take it away from here.
Thanks, Brittany. Thank you, Brittany. So let's see if we can share screen. I think you need to stop sharing the screen, maybe, Brittany, and then I can. Okay, let's try this here. There we go. All right, let me know that you can see that. Looks good. Great. Well, it's wonderful to be able to talk with all of you today. Obviously, we're going to talk about your first private alternative investment. That's why you guys came here. And we hope that we can help you avoid a disappointing investment. Now, of course, we'd love to see your investor dollars in our fund, but it's not a fit for everybody. But in general, as you look at different alternative investments, we want to teach you with this some top level items to help you really determine upfront whether something matches for yourself or not. In the end, if you think about what kind of approach are we talking about here? Think about it is that manager. So every private investment, just like every company, has a CEO, a board of directors. Every fund has a fund manager, or managers in the case. So Chris and I are the managers of the Kirkland Income Fund. But is that manager or managers of that fund in alignment with you? What you want a picture in your mind is really what you see on this cartoon we had drawn up. You as the investor, you have the money. You should be in control of your money, not the other way around. Yet too many times in the industry, really it's the fund manager thinking that, well, I've got your money and now I'm the king, when it should be the other way around. So as we go through these things, think about how do you make sure when you're looking at an investment, is that manager with you? And I'm super happy to have my partner here, where my expertise really lies more on the real estate side. And I've learned a ton from Chris. I'm really happy to have Chris along here because he has had his whole entire career making sure, whether he's worked for wealth management for high net worth and early on in his career, or whether later on working for other fund of funds, he tearing apart other funds that they invested in to make sure that the manager was aligned with them at the time. So he spent his career in making sure that they were investing in things that were well aligned. And so it's been great to have him along as we built our fund. And I think he's going to have a lot of stuff to share with you today as we walk through these things. And I put a lot of questions to him. I won't go through here too much here. Chris, I don't know if you want to say anything else about yourself here.
No, we don't need to do that.
Okay, great. And I don't think I need to say anything about it more. Brittany did a great job here. So let's just move on. So here's the 4 factors we're going to cover. Documents, or the manual, as Chris likes to say. This is the manual that we're supposed to follow. So if you don't read the manual, well,
sometimes I'll call it the rules to the game. You got to read the rules before you're going to sit down and play the game.
That's right. The rules to the game. Fees. What are you being charged? People would be surprised to know that even no load mutual funds or some of the stuff you buy in the public markets, there's fees in there. They're not zero. It's just depending on how those fees are treated and how those fees are passed through to you. Operations. So how well does that operate? And then finally, transparency. It's a fund. There's certain things that funds can't be completely transparent with, but you want to get as transparent as possible. And you want to know what's going on. What is that fund manager doing with your money that you're relying on? So let's dive into these things. Number 1, documents. There's 3 of them here, and I'm going to have Chris go through and talk about each one. But private placement memorandum, I would say actually that's really kind of that rules of the game you're talking about, Chris. Is that right?
Yeah, no, and it's actually got another name also. Some people just call it an OM or an offering memorandum as well. One of the key things I want to state with here is we've kind of chosen, it was tough to choose which 4 out of about 50 things you have to pay attention to. So we tried to grab the ones that would be the most encompassing, that would give you the broadest breadth to generate further questions. And make sure that at least you got the highest probability of avoiding something that's not going to fit your portfolio or be working with someone that's not going to be a fit for you personally. So just let you know, this is not the do all of due diligence by any means. But
I think that's a good point, Chris, that you made, that we're not covering everything here. But when you're looking at stuff, particularly at the beginning, you're kind of looking at what can I quickly move away from? I can quickly decide, hey, this fund definitely not for me. Yep. I think that's what you're kind of saying here, right?
Yeah, get to the know quick or get to the I want to know more. Right. So documents, it is the rules of the game. I will tell a funny story. I do actually help people out every once in a while. If you happen to know me personally and you want to go into an investment, you can send me a doc and say, I really don't know what I'm looking at here. Can you give me an idea? I do that for a few people. And the recent one that I had was the guy sent me a sub doc and a marketing doc and a short operating agreement. And I looked at it and I said, well, where's the information on the fund? What are we investing in? What are the risks, the conflicts of interest that the manager is aware of? And what Brock was alluding to earlier, a lot of that will be embedded in that private placement memorandum. It is that comprehensive legal document. It is usually long. It is usually boring. But I will tell you, you need to read through it. You need to understand it. It is literally that end to end. Well, it should be. Everything should be in there if they've drafted their document correctly and they have a decent lawyer But it should be that document you really spend the time reading through, understanding, and generating questions. If you read something and you don't know what it means, there's no such thing as a dumb question. Be sure to ask. If you can't get the answer from your manager, that's an initial clue right there that, wait a second, does this guy actually even know what's in his document? You'll be surprised. There's a lot of managers out there that have a lawyer create these documents for them, and they really don't necessarily read them and understand them as thorough as they should, as you know, it's the rules to their game. So that is the first document I start with. I don't really bother with any other documents. I'll look through your deck really quick. It's usually some pretty pictures, and it gives me an idea, or at least builds a premise of what I'm going to be looking at with this fund. But the real document for me is that PPM. That's what will drive me to that next decision if I'm going to keep reading.
Okay, that's good stuff. So let me just make sure we understand, because if we're talking to people who are doing this for the first time, you're kind of saying that, maybe look at the presentation deck they have. Most fund managers have one, or maybe these days they at least have a web page they're going to send you, or some sort of document with highlights. But and if that matches, then the next thing you want to move to is you really want to request that PPM, right? And go through that.
And it should be part of their natural process. If you talk to a manager and you've got their deck and you've maybe had a meeting with them, you should be moving or have access through a portal or some other source, get access to that PPM. That should be your next document.
And the reason I've read a bunch of these, nowhere near the thousands that Chris has probably read, but the reason I kind of put the iPad and the notebook and the cup of coffee down there is that really should be you on a Saturday morning sometime when you're fully awake, because these things are anywhere from 60 to 100 pages. And you think, hey, this investment looks really good. You grab that PPM, load it up on your iPad, because they're usually in PDF, and get your notepad out, and you go through that thing. And you're going to write down every question or everything that you don't understand there. So you have then a bunch of stuff to go back to that fund manager and say, I don't understand these things, or please help me understand these things. And believe me, we expect when we got someone that doesn't read the PPM or doesn't come back with questions, we got to kind of wonder about that person. It's actually better. We like it when people come back with questions.
Yeah. And I mean, and if you don't feel comfortable and you don't have the knowledge, there are people, I mean, you can reach out to even I'm sure some various resources within Verivest itself to get some answers on some things about the PPM, because I was very impressed very early, where obviously someone within the Verivest empire read our PPM and came back on some very specific points that were buried deep. And I laughed and chuckled, and I said, well, I don't think I've ever been asked that question, but I'm glad you asked it. So so I mean, there are third-party resources that can help you understand if this is your first time you're coming into an alternative investment and you don't feel comfortable. I will say this, I know I'm not going to make any friends with lawyers with this statement. A lot of people go to their lawyers to read these for them. Unless your lawyer has a knowledge in alternative investments, and that's something they truly specialize in, that's great. They'll understand what they're reading, and they'll be able to identify some snags if they exist, or if it's not really, but they shouldn't be. Lawyers aren't licensed to give investment advice. Right. That's not what they're there for. It's not their knowledge base. It's not what they do. And so just be very careful and take things with a grain of salt, and make sure that you understand it for yourself, and you're having the right help with some of these documents.
I mean, bottom line, if you're going to sink the $50,000 or $100,000 minimum that is usually required for a private investment, it is definitely worth your while to read these and understand it. So once you read that PPM, you feel like you got your questions answered, you feel like, hey, this is something that I think that is a good match for me. And then obviously you're going to move on to that OA and subscription. So you're going to want to break down those two documents for us, Chris.
Yeah, the operating agreement is there again, that relationship between, or another name for it is the limited partner agreement, depending on the structure of the fund, or LPA, as some people use the acronym. That is the further rules of how your relationship as a limited partner or a limited member it works with the fund, and how things, it's a process and procedure document of how things will carry out and how the fund actually operates. Less about what it's doing, less about risks, but more about, hey, if this occurs, then ABC will happen. It should walk through, and some of it will be duplicative, to the private placement memorandum. I mean, there's just certain aspects that just naturally would show up in both documents, but this is just that further explanation so that you understand your true relationship legally as a limited partner within the fund.
Okay.
There again, further expansion to the rules of what will happen in various occurrences. So a lot of that stuff is situational. You may never run into half of the things you're reading into in the OA, but it will be a document you'll have to go back to and sort of assess if something does occur in the future. I mean, even with regards to like, hey, I want to redeem from the fund. How does that actually work? Okay, well, that'll be listed out. The exact procedure of how that should proceed is in your operating agreement.
Great. And then the subdoc or the subscription agreement. Yeah.
We don't have to spend too much time on this. The subscription agreement, a lot of these are very templamatized. The real importance and why I want to mention it here is it is the legal proof of your ownership. It is the document you actually sign. It is the one that you prove if it's a fund that requires accredited status, they may have an entire accredited status document there. So if anything, there's any challenge to your ownership of the fund or the nature of it or the timing, that subdoc is the proof. And that's why it's important. And I want to mention it there. But it's not, you'll find from one subdoc to another subdoc, depending on the nature, if the funds are very similar, you won't see a lot of differences or changes in structure. I mean, there are other documents out there. Some of your bigger funds might have due diligence questionnaires that goes into listing out everything you could possibly imagine around compliance, business continuity, and operations around the fund into a granular level. That's a very institutional level document. You won't see that in a lot of small funds. So don't run around and think you're coming into a smaller fund and say, hey, I'd like to see your DDQ, that due diligence questionnaire. They may or may not have it, but and another document you might see is an FAQ, which is the frequently asked questions document, which will be a little bit more common. And hopefully that dives into some of the questions you might actually have that would come from reading in the private placement memorandum.
Yeah, great. One of the things I'll mention here too is, what's great about Verivest is they've gone through these documents to kind of vet them. But on the other hand, though, what they don't do is they don't necessarily decide for you whether this is the right investment for you. They don't decide on the fees, they don't decide on when you can get your money back or any of those things. So those are still things that you have to match. And back to that cartoon, you decide whether that the manager really matches what you want out of your investment for this.
Correct.
Okay, great. Let's move on to the next item.
Yeah,
fees. So
yes.
I mean, look, everybody charges fee. No one does anything for free in this industry. There's no free lunch.
Let's put it that way. I'm aware
of. So it's super important to understand what fees are out there, the type of fees, and it doesn't mean that low fees are necessarily a good thing. I'll say that right away. And I say that as having Kirkland Income Fund as we're like one of the lowest fee funds out there, but there's a reason for that. Other types of funds are not able to do it because of the nature of their investments. Yep. So don't necessarily look for low fees, but be aware of what your fees are, particularly as you compare it to other things. But now I think I'll let Chris kind of go through and, one of the biggest one, everyone's going to charge a management fee. So why don't we start with that one, Chris?
Yeah, no, and I mean, as sort of keeping this in, I mean, there's a lot of things mentioned right here. I laugh when everyone always tells me, I'll tell a short story. I had a very prominent investor. Obviously, he didn't read his documents, so he was not paying attention to slide 1 that we just covered. He was like, well, I only pay 2 and 20. I don't have any other expenses. And I was like, I'm pretty sure that's not true. And we actually made a bet, the usual bet. If anyone knows trading places, it was $1. So he gave me his PPM and I read through it and I found all the other fees that he was paying that he was totally unaware of. So keep that in mind when people talk about, oh, my fees 1.5 and 15 or 2 and 20 or 5 and 50 or something of that nature. That's not all of it. That's just what like people want to, that's the common nomenclature that people like to sort of just make it simple. But let's dive in. I mean, management fees, the actual definition I was given years ago is that should be the fee that covers the cost to run the manager of running the fund. That's what it should be. You'll have to dive in and assess that a little bit if that fee makes sense and that's covering the cost of the manager. And 2 reasons you need to assess that. 1, is it a compensation scheme where they're just getting rich on management fees? Or 2, the other side, are they charging enough to actually truly maintain the manager?
Let me
Because
ask you
as a
about this
manager,
compensation
yeah.
fee, compensation scheme. What do you mean about that? About, them getting rich only on management fees? So what's wrong with that? If I'm an investor, I'm thinking, okay, well, this seems like a great investment. Okay, the management fees are a little high, but it seems great. I mean, what they're promising me is really nice. What would you say to that?
Um, well, that might be true. Listen, you can look at very high fees and you got to look at the net returns and say, well, wait, these guys are charging a ton of money, but their net returns, they are still creating an amazing amount of consistent alpha and outperforming the market. And they're charging 5 and 50. I gravitate to that number because there is a fund in the world that charges 5 and 50 and still beats you.
Wow.
I mean, they
There must be
consistently
some secret sauce there.
Yeah, they consistently beat their competition. So I know 5 and 50 sounds ridiculous, but when you could beat everybody and that's what you're charging on a net basis, you got something. But you can probably Google it to figure out who that is. When I say compensation scheme, really, it's what a lot of, unfortunately, occurred in the early days of alternative investing, where you had a small fund charged 2 and 20, and they definitely were meeting their management fees, and then their team had to expand, and all of a sudden, there's the leverageability of this business to where all of a sudden I'm not running 200 million, I'm running 5 billion, but I'm still charging 2% management fees. Well, it's not tough to think that 2% management fee of $5 billion is no longer just covering the cost of the manager. It is way beyond, especially with the growth of technology we've seen in the industry, to date. It's only empowered, this industry's ability to have leverageability of needing less people and able to capture, achieve the management of a fund for less.
So that's what I mean. The biggest point here, takeaway, is that if you're seeing this management fee, particularly as the AUM or the assets that fund has grows, if it's out of proportion, that means that they're really no longer incented to do well on performance. That means that even if they have poor performance or negative performance, they're still collecting that management fee,
not
right?
necessarily. That is one possible occurrence. Everything is a probability. You can't identify one thing by one indicator. And this is just, we're talking about the rough definition of what a management fee should be.
Okay.
Just like I went back to the other thing, the guy charges 5 and 50. Well, is he worth it? Yeah, he beats everybody. So is 5% too much, even though he's running billions? No, yeah, of course it is. And I mean, how would you possibly argue otherwise? He's beating everybody.
Right.
And so that's what I just really want to, management fee is one of those things. Dive in, obtain that transparency, understand, can this manager maintain itself when it achieves its goals? Understand where this gets into, like, well, what's the capacity of the fund? Where's this manager think they want to be? They're running 50 million, they're running 2 billion. What's their real goal? And understand that business. That's where it's important to understand management fees.
So then let's talk about these incentive and performance, because that seems like, as an investor, I want that manager to be incented because that's going to help me as an investor.
Correct. And it also gets into one of the potential conflicts of interest. In alternative investments, it does require usually a specialized network, knowledge base, or a combination thereof to achieve an alternative investment of any type. We happen to be in debt, but in my previous life, I did cross-border arbitrage for a hedge fund. And we were worth every ounce of our fees. And so when we outperformed a series of benchmarks or other hurdles that might be embedded in the language of the document, we were incentivized, with these performance fees. It is something that has been a contentious point for a lot of institutional investors. They always want to see less, but I'll talk to you about the conflict of interest now with regards to incentive fees. You want to incentivize and have the smart people running this trade. So you need to make sure that the incentive fee is commensurate with that. The other side of that coin is you also need to make sure and monitor, is this fund or this alternative investment has style drift? Are they going outside their bounds, understanding their risk? Are they taking excessive risk to maximize incentive fees over a certain hurdle? That's where I kind of really, when I think incentive fees, listen, okay, 15, 20%, whatever, we'll figure out if that's warranted or not. But where I'm concerned is, do they have a team of Wild West guys that are out there really pushing the envelope to try and maximize those incentive fees at the risk of the investor?
That kind of goes back to the PPM that where you talk about in the PPM is laid out those risks in the manual, so to say. The rules of the game is laid out. Here's the risk that they should be taking or limiting themselves on, and what they should be investing in. And when you say that style drift, what do you mean by style drift?
Style drift is they'll have a certain number of parameters that they'll invest in, and this is what they say they do for their fund. This can get a little wonky because we're talking about alternative investments, which really can be a little bit of everything. And so some of your multi-strat alternative investments can have very wide bands of what they can trade in. So it's hard to determine, are they within their risk parameters or not?
Right.
But a lot of guys are running third-party risk reports. In today's world of algos, there's computers that can calculate a lot of this across multiple complex trading platforms. So, I mean, any good fund that is, saying, hey, I'm going to be a multi-strat and I'm going to be in 10 different places, they should be pretty advanced in the systems and the capability of understanding their risks and being
on the other
able
hand
to look at that.
I know a lot of Verivest, it's very real estate focused. So I would expect that if you look at the PPMs across the board and you can look at our PPM, it's really narrow about what we do. I mean, we invest in commercial real estate debt, period. We don't do anything else. So all of a sudden, if we wake up one day and say, oh, hey, this going and buying this this business over here and giving debt to this business, hey, that sounds like a good idea. I mean, it's a high rate of return, but yet it would be outside of what we said in our rules we would do. So that would be something we wouldn't you should watch out for.
Exactly. I mean, it may even still be in real estate, but all of a sudden we start buying like pref equity pieces in syndications. I mean, that would be enough style drift outside where I'm clearly taking risk way beyond what I said I was going to do in the fund. Okay. Now, fund expenses. This is the one. There's going to be a section in your documents. They will go through and they will list out a laundry list of things that will be embedded in your fund expenses. It will be no short list. The one thing I always try to look for is, how much people are embedding marketing and other expenses, the ability to go raise other people's dollar, spending your money to raise other money. It's a personal taste. There's no rule that says you can't. In 2008, there was a lot of pressure against that. I know big institutions have a lot of pressure against that. But in smaller funds, maybe it's a little bit more accepted. And sometimes you got to dive in and get that transparency of, well, how much money are you spending on marketing? And is that embedded at the manager? And how is that, and how much flows back to the fund? Ask those questions, understand what those are. So don't just read the section under fund expenses and go, oh, wow, that's a lot of things they're charging me for fund expenses. Really dive in and make sure that you're okay with that your dollars are going to pay for those things for the advancement of the fund. And then what are they also embedding at the manager? What are they paying for at the manager? Now, the next one, the acquisition fees, refinancing, disposition, those are a little bit more on the syndication side. I threw them in there because it's something that
pretty common for those multifamily syndications we see.
Exactly. There again, there'll be more layers of fees in syndications. May or may not mean more dollars out of your pocket, but it's something you need to really dive in. There again, read through the documents, understand, how much is coming out of my investment.
I think for those, one of the things to watch out for is there's nothing wrong with any of those fees, acquisition, refinancing, disposition, because as you look at them, they are fairly well aligned with the amount of work that a manager has to do at each one of those gates, so to say. So if you have a multifamily, there's a lot of work that goes into acquiring that asset. And then, if you ever bought a house or refinance a house, you know how much work it is, even just on a house, getting all that stuff together. You can imagine how much work it is on a large multifamily to get stuff together and do that stuff. So it tends to be well aligned. Disposition, all the work to get it ready for sale, et cetera. That can be a lot of work as well. So not those fees aren't wrong or bad, but it's good that you kind of understand them to get a picture, an overall picture of the entire syndication, what it's going to cost you as far as those fees go.
Yeah, it's like the other fees that would be embedded in the fund. You just really need to understand and maybe even ask the manager to itemize it out for you.
Yeah.
I mean, there again, it's sort of a test of transparency. Can you
so what's
tell
a
me
fee?
How much?
What's a fee spread?
Fee spreads, participation skims. I mean, there's just been, I've had people throw a lot of names at this one. This is very debt to debt real estate related. This is not something you see especially in my institutional life. I only saw this when I started working in the smaller funds, and specifically in real estate. It's very common to where I will go out and I'll write a piece of debt, whether leveraged or unleveraged, at 16, 17%. And then I have achieved that, where I went out and I borrowed money from you as an investor and I'm paying you 9 per se. And so you're taking that spread between those two of 7%. Well, okay, that's a lot. I mean, people poo-poo hedge funds for charging 2 and 20, and if I have my hedge fund that goes and makes 10%, and I charge 20% of that, let's just say no hurdles or anything else, that's 2%. So my total fee as a hedge fund on my AUM would have been 4. But technically, if you're dealing with funds that are running debt to debt, these spreads can be quite large. Things also with like revenue shares. If you get into a fund who has a revenue share structure, really have them walk through that so that you can understand, well, what does that really mean in aggregate fee? Because they're kind of hidden and they can be very large numbers. One of the things that you'll see also in, we'll back up a little bit here, sometimes in fund expenses, if you read a document and you're looking at something this is not very common in real estate world, but in hedge funds, it can be, is what they call pass-throughs. Pass-through structures is where I basically just take every expense, everything. I bought toilet paper yesterday, so I'm going to put that expense to the investors. And it's a pass-through structure. And there again, it's hard to understand, well, what does that fee actually mean? So just like, revenue shares or fee spreads, really there again, you got to get that transparency and that comfortableness around, well, what is the actual fee at the end of the day I'm paying? Because there again, there are some funds out there that do pass-through structures and the end pass-through is like a 9%. Oof. So, I mean, it's huge, but there again,
if they're delivering
they
30% return to you, then maybe they deserve it, right?
But it's a little bit of a, makes you gulp a little bit, like, wow, the pass-through structure net to me is a 9% fee. I mean, so I'm not saying none of these are good or bad. I'm just saying you need to be aware they exist and you need to understand what they are.
Yeah, it seems like the thing on the fee spread that we've seen before is where you're not actually investing in the fund, you're actually lending to the fund at a standard rate, 8 or 9%. But then they're going out and lending this at very high risk. They're going out for as much as they can. They'll do a 16% loan to a high risk thing, knowing that, well, if we lose it, it's not off us, it's the investor. And meanwhile, they're making it. So
yeah, hopefully you're not working with a manager that actually views the world that way. He's taking much more fiduciary view. But you are correct. I mean, that's always been my biggest concern with, big spreads is what it really means as an investor. You're being exposed to a lot of risk and not being compensated for it.
Yeah. So you're saying
the biggest concern you should think about.
Right. Not that fee spreads are necessarily evil or anything. It's just that if they get too out of hand, then you got to kind of watch whether that manager is really in alignment with you again.
Yeah. And also you could easily say, and I've heard this, it's like, well, listen, I have a particular niche where I can charge a fee like that or run a spread like that because you can't get it really easily anywhere else. And
makes sense.
And so there is justification to some of these fees a lot. It's just, I just want to harp on the issue of know they exist and make sure you're comfortable with it. And sometimes if you feel people squirming when they're talking about their own fees or they avoid talking about fees, that's usually an indicator that they're not happy with their own fees as if they wanted to pay it. And lastly is kind of an interesting one that I ran into a couple times. One just recently within the last couple of months is formation costs.
You mean the formation costs?
Yeah, the formation costs is something that a lot of people really don't think about. There is a section in the document that'll talk about your formation costs. It'll run through and really identify, hey, this is how much money we spent to do this, and this is what the fund is liable to cover. And so what they'll do is they'll spend.
So hold on, just to make sure we're talking. Everybody's, because people may not know what a formation cost is. So that's really the cost to set up the fund, all the legal costs, banking costs, you name it. That this can run what I mean, low in the case of us, where we kind of you knew what you're doing, so we got a break with the lawyers. But to someone who doesn't know what they're doing, shoot, we've seen $150,000 formation costs, right?
Yeah, and there again, there are some strategy types and structures that will cost more to create.
Okay, good to
And
know.
so you will have formation costs that will be higher. It doesn't mean that, oh, you paid 50,000 in formation costs and this guy paid 150. Well, the guy who paid 150 is clearly, doesn't know what he's doing. Not necessarily. You got to
Okay.
understand the strategy and what it really takes to pull it off and what kind of structures that person needed. And there again, I want you to be aware of this fee structure and understand what are they putting back, because it is pretty common. I know this is bad to say, but hopefully nobody, at Veravest or anybody else is doing this, but they'll basically come in, they'll rack up some big fees and they'll put that to their investors, which creates a pretty big hole to walk out of. It's an initial drag on the fund's return. And so that's why it's important to understand it's there. It can create a dip before you even get started. And then you got to understand that if it's a new fund, how much of that's being allocated to you. I will tell you, like I said, I was dealing with this just recently with a company that was going to register with a Department of Financial Institution at one of our states. And the state didn't like the fact that they were going to basically back charge about $125,000 to investors, that they really thought that the new norm should be somewhere around 50. I'm not saying that's right or wrong. I'm just saying that's what the Department of Financial Institutions came back and said, I can't believe you're going to put $150,000 of cost to build your business back on the back of the investors. They had thought it was more normal to see something around 50. So whether you want to draw a line in the sand on that or not, that's your personal choice.
It's just really understanding how much under. So when you put in 100,000, your actual value of your investment is all of a sudden less than that on day one because of those formation costs. It's just something to be aware of.
Yeah, and if you're coming into a fund that's been around for a long time, it's a worthy question. Oh, is that been paid off? Is that done? Is that out?
Yep.
Is that still being shared out? How does that work? That's a question you want to put on your list.
So again, it sounds like none of these things are wrong or bad. It's just really take a look at it and see if those things align with what you want out of the manager, and the manager is really aligning themselves with to do the best for you. I mean, all of us are in this to make money, of course, and make money for the investors. So, obviously you got to pay for that. And it's up to you as investor when you're looking at those to decide how much am I willing to pay that manager for that service of making money for me.
Correct.
All right, let's move on to the next, operations. So operations is one of those interesting things that it's almost something that most people don't even think of. They think of primarily, okay, I'm putting money in and this trader or the fund manager is going to make these trades and make a lot of money for me. And this kind of operations thing about money movement, about controls, about operations, about well, now cybersecurity, due diligence, process and procedures. I mean, these are all some huge items that are in the background that take a tremendous amount of time. So Chris, why don't you talk through a few of these things and maybe use even what we've done at Kirkland Capital, with the Kirkland Income Fund, talk through cash controls and third-party integration. Maybe start with the cash controls to start with, because who's got the sort of the finger on the trigger can actually move cash around, because that's been a big deal with fraud in the past.
Yeah, no, I mean, I spent years actually developing operational programs for the assessment of alternative investments. 09 and 10 was a pretty interesting time where people realized no one was watching anything and no one cared about operations. It was all about investment due diligence. And what they realized when everything was breaking apart, and even in some of the frauds that they'd run into previous to 08, the failure didn't occur at the investment level. The failure occurred at the operational level. And I think that the ratio is down a little bit. It used to be as high as 66% of fund failures was operational related. I think it's closer to 50 now.
Still, that's amazing. If half of all fund failures are not because of trades, but because of operations, then this is definitely something that, as a first-time investor, when you're looking at investing in a private fund, it's a super important item to look at.
Yeah, I mean, a lot of people, they focus a lot on the investments. And I think there's an error made in the psychology of alternative investments. Is you got to understand the investment. And yes, that's where your money may need to be deployed. But at the end of the day, your money is going into an investment as an LP into a company. You are investing in a company, and that company has a management agreement with a manager and has its own operating agreement as its own entity. And so you got to understand how the assembly line works. So a lot of people want to look at with a widget and understand how cool that is and how that can be valuable to them, but they don't bother to pay attention to the assembly line that made the widget and how, I mean, and we all know how assembly lines work. There's about 100 different steps to it on how it goes from A to Z. And that's the important aspect of operations. And I mean, we could spend days on this, so I'm going to be pretty short. A lot of it is around, and what came out of 08 was there was no longer allowed to be self-administered, which means you basically did your own accounting, your own back office, your own middle office. It was all inside. It now needed and was required to be monitored by an external third party. I'll laugh. This is where I first met Lance when he was starting his administrator, and he was embedded in a fund. And I said, well, you're going to have to change that. 6 months later, he called back and said, wow, you were right. And I go, yeah, well, and that was back 08, 09, when people were just getting used to these rules. Yeah, I mean, people are just getting used to these rules back in 08 and 09, and now we kind of take it for granted, but it's still equally as important as new threats arise, like cybersecurity. But this is where you have those third parties in place that are looking over your shoulder, like a Verivest is a great due diligence tool of where they're coming in and asking the questions and making sure that information's collected. And, you know, now it's you pretty much, if you want to go anywhere, you got to have a fund administrator, for better or worse. It depends on what time of day you catch me. I'll either be pro or against fund administration. But whether I'm the hedge fund trader or the guy, you know, who wants to, you know, make sure.
Well, I think bottom line, as a fund, it's, you know, dealing with all these third party administrator, everything, it takes time.
Yes.
And I mean, it's sometimes frustrating, although in the end, it's good for our investors and good for us too, because it protects us from making mistakes as well. Right?
Correct. And like the list has here, you got, if you're something that has to be custodied, who's your custody agent, you know, or your administrator? Do you have an auditor that understands your particular business? Do you have tax in place? Do you have banking? Do you have securities, legal representation? If you're in the real estate business, which we all are, do you have real estate counsel? Does the fund have all this in place? Who are they using? You don't always have to be a big name. And this is the one thing that is a misnomer, because I've worked with the big names and I've worked with the smaller names, and it really sits on the fund's capability and the managers to work and help their third parties really understand what they're doing and work the way that's best for that particular fund, because everyone's a little different. You don't need to have a big name. I get it, though. A lot of people want to name drop. If I'm going to go out and raise money from major consultants, they're going to want to see a big four on the accounting side. I get it, or you're never going to get money. But when you're talking with smaller funds, find out, you know, okay, why did you use this administrator? Why did you use this auditor? You know, or banking, you know, walk through those, ask those questions. And that's the key aspect to this whole adventure we're going on here, is to give you hopefully an insight of what to pay attention to and ask the right questions. Is why did you choose those? How do they work with you? What's the pros? What's the cons? You don't always have to know. It's not always a name brand, but as Brock was saying, having those right people in place, they're looking over their shoulder, over your shoulder. They don't have an interest in doing maybe what's right for the manager. They have constant of what's right according to rules and regulations, and that usually falls in the camps of it's going to be right for the investor. And that comes down to cash controls, you know, who can move money. I think this is a huge one. It was super scary. I'll tell you a funny little story. I walked into a hedge fund and I walked right past their front desk because no one was there. And I walked into this little room that they said was their wire room, sat down and sat at the computer. And this is all pre-08. This is the kind of due diligence I used to do on on-site verifications. I was pretty nasty. And what it showed was I had a complete stranger that wasn't even part of the fund that walked into your fund, walked across the threshold, walked into your quote wire room and sat in front of the computer where you control all your wires. And it only required one single person to do so. But you can imagine after my meeting, a lot of that changed quite quickly. But it also now has become normal to where there's no one single person who can move money. There's a CFO, there's another partner, there's someone else, or maybe even you have a trifecta of some level of control if you're a larger fund that has lots of movements, some type of automation and rule writing between your fund administrator and yourself, and even maybe your bank. It can get fairly complex, depending, and you don't want, as a fund, you don't want to make it too complex. I mean, if you're a small fund, and you're an investor looking at a small fund, you'd literally want to see, okay, well, where's the dual control? Can Chris come in and start an offshore fund in his name and move money?
Well, and for example, for us here, we're a fairly small fund, but we from day one put in those cash controls so that, for example, when we need to, because I just did this the other day, we need to put a wire out to fund a loan, but put the wire to the escrow. So we've got a whole form that gets signed off, that the due diligence for that wire, the amounts, where it goes. Wire fraud is a big thing today, so that the telephone call has been made to confirm the wire, the banking information, and then that goes to be signed off by someone else. Chris, in fact,
to be exact, Brock is the originator.
Yeah.
I'm the reviewer and second signature. And when I go put the wire in, it then has to be reviewed by the CFO, because she's the only other person who can actually dual sign the completion of the wire. So
in our small fund, we've got 3 signatures to make sure that nobody can, send out something inadvertently. And at the very minimum, nobody can just send off some wire accidentally, because that requires dual control.
Correct. So yeah, I mean, we can take some questions about operations, but we could go on and on and on.
Yeah.
I mean, we can kind of move on, because I know we're probably running out of time. But yeah, we can take some questions on operations, because it's a rabbit nest. It's lots of tunnels, taking in lots of other stuff. But
yeah, I think the bottom line is you've got it down where, take a look, ask the questions to the manager again in that phone call that you're going to have with them about, hey, tell me a little bit about your operational controls, particularly around money. How do I know that someone's not going to easily break in and steal all my financial information? Just those kind of questions. What's in place? Have a conversation.
And I know it's tough in today's world to verify everything, especially in the new world we live in, where everyone's all over the place. But if you're writing really big checks, I mean, we're talking 7 figures plus to a fund. I'm a big believer in on-site verification, whatever that might be in this new world. But that's what I spent a lot of hours. I think my record was I spent about 8 hours inside an office, going from all the way to the top to the bottom of a hedge fund in New York. They were happy to see me leave. But that's I'm not saying you got to be that thorough, but if you can try to get some type of on-site verification and really kind of, okay, hey, is there really people? Do it if you can.
Yeah. Otherwise, Verivest provides, that great level if you're not doing the 7-8 figure checks, right?
Exactly.
So let's move on to transparency. This is one thing that, Chris, from the very beginning, as we put our own fund together, has been big on, hey, let's be as transparent as possible. Let's let, we do loans. So, let's let, once the loan is started and booked, then, let's let them know, hey, here's the address. Here's, you can go look at it. You can go look it up. You can go look up, because property records are public records. So you can go up and look and see our lien on the property, all these things. So in this transparency deal, let's talk a little bit, Chris, about what's your opinion on this, a trade transparency versus opaqueness. Let's talk about that first. I mean, how do you balance? How do you know when someone's saying, well, I can't really, a fund manager says, I can't share that with you. How do you know if that's actually legitimate? They're saying that's really an issue, or whether they're maybe hiding something?
I'll give you what I used to say, but let's go through, trade transparency and opaqueness. There are strategies that are what they call a zero sum, whereas like if there's $1 in the trade and I tell you how to do the trade, you're going to take 10 cents out of it. That comes directly out of my pocket. That's the definition of a zero sum. So everybody who comes into that trade is taking a piece away from the only dollar available. That is something where there needs to be a level of opaqueness. There are funds that actually require that. It's important. It was what I did for 8 years. I couldn't tell anybody what I did, because most of the trades I did in arbitrage were zero sum. And so it's not always a negative. It's not always a negative thing when someone says, I can't tell you. But what Brock's question is, if you don't think it is, and I'll tell you, be careful with this, because it's not always the nicest statement. I would go and I'd say, well, listen, if you're not going to show me what you do, that means one of two things. It means it's not really that difficult. Therefore, you have a low barrier entry and it'll be easy to repeat your fund, which means somebody smart coming in off Wall Street will easily take away your trade. Yeah, that was, or it's so simple I could repeat it just by you telling me how to do it. That was one of those things with, that I would say to people, is it really that simple? And often not, it wasn't. And so you'd get access to kind of sit with some traders and walk through, or have somebody kind of walk through and show you some of the inner workings of the trade. But if you can get trade transparency, I find in real estate, especially once the trade's done, I mean, one of our mottos is like, once I have a loan in place, I mean, it's done. I mean, I have no problem telling you about the loan. It's not like my previous world. It's one of the things that I loved when we were building this. I was thinking about all the moving pieces of what I was going to be capable of doing. And I'm like, oh my God, I can be transparent almost about everything. Once I pull the trigger, I can tell people how accounting works. I can tell people what trades we have in the book. I actually, want to give you that transparency. So the key aspect of transparency within the trades is understand the nature of what the fund is doing. And usually just apply a lot of common sense. We're not talking a lot of high knowledge level. It's just,
and that's kind of fun with the real estate stuff.
Should I be able to get access to that information without hurting the fund? Because if the fund is, I mean, this is not good for you. If they're going to tell you all the secret stuff and the fund goes and tells everybody else that secret stuff, well, then that fund's going to be out of business pretty soon.
Right.
I mean, so that's not good if they're sharing information that is very key and super secret to their strategy of how they're getting excess returns. But otherwise, you should be able to get that.
That's what's kind of fun about real estate, Chris, is that, shoot, it's so transparent that, I mean, you could go look at an address and go do a Google drive-by, or if you live nearby, go drive by and see, hey, I'm going to invest in this fund. I'm going to own a piece of this particular real estate. Whether that's on the loan side or whether that's on the equity side. That's kind of fun.
There is a tangibility to this in this alternative investment universe that's not present in a lot of others. So I mean that is nice.
So if you don't recognize this, or this is a restaurant, I'm sure many of you have been to a restaurant where you can see the chefs working, and I always kind of like that, because it's like, well, you can't have a dirty kitchen. You're fully exposed. You maybe not see every ingredient that goes in there, but it kind of gives you this nice sense of confidence when you see that transparent. You can look through the window and see what's happening there.
Yeah, the background picture to this slide is showing you how they're making the food that you're going to eat. So, I mean, and that is the nature of the transparency you want from a fund as well. The key aspect to transparency, the amount of investor communication, the form of investor communication, is that ample for you? Everyone's a little different. So that level of transparency, some people might want, hey, I want to have a monthly one-on-one call. Other people are like, well, I don't want to talk to you. I just want to listen to your quarterly update. And then not every fund, small funds will be audited. So this point here with audited financials, yes, it's a form of transparency. Not all small funds will be audited. There are auditors out there that are specializing in small funds. They are cost effective. I mean, it's still not cheap. But when you get to a certain size, and it's something, I think it's not the do all of everything that a lot of people like to put it on this pedestal. But it is an extra checkpoint. It's an extra level of comfort to see audited financials. And so, I mean, that's something that, maybe a form of transparency that, maybe you just require. You won't invest in a fund that doesn't have audited financials. I mean, that's your personal choice. Government registrations. The reason I mentioned that was just understanding how they've registered, how they're exempt. Did they build the fund correctly? If you have a base knowledge, or you'd like to understand a base knowledge of how funds are built and why they're put together the way they are, it can be actually quite telling. Did this person put together, I'm going to go a little deep here, a 506C exemption or a 506B exemption? Well, okay, there's different rules for those exemptions. Ask the question, why did you choose to do that?
Right.
You know, so that
Right.
you can understand and get into the mind of the manager. Isn't that really the job of what we're trying to do in due diligence? Is, you know, get into their mind and understand, well, why are you doing it this way? And does the say and the do constantly match? That's what we used to say when we would tear hundreds and hundreds of hedge funds apart. We'd walk out of that meeting, we'd be in the elevator, leaving the meeting, and I'd always ask some of the junior analysts, well, do you think the say and the do match? And if you don't, why?
Mhm.
So we'd have like an elevator talk on the way down from a meeting of what they thought was maybe a little wonky, or what was, you know, we couldn't find anything. We think these guys are rock solid. And some of that came out of, do you think they put the fund together correctly? Are they doing it, you know, to meet what their objectives are? And then, you know, there again, third-party verification. We've talked about it a few times. It's a big piece of that, the operational piece is understanding, like, well, who do they have in place that is looking over their shoulders and offering further capability of transparency. It's one of the things that you know, Kirkland Income Fund was able to get listed on some fairly big and difficult alternative investment platforms for investment. And a lot of that came from our process and procedure manuals. It came from our aspects of our continuity, our third-party verification aspects, and, you know, a lot of this constant focus for us on the protection of investors' dollars. And that's what will eventually get you on some of those platforms, because those big platforms, that's what their main focus is they're not there to condone your investment. They're there to make sure you've built the right structure for the safety of their investors. And a lot of that comes from third-party verification. And if you're worried about third-party verification, here again, you're obviously on this call. You all know who Verivest is. If you don't, you can go look them up. I was just on an investor call today, and he said, "Hey, I found you on Verivest, and I was supplied a ton of information about you. I'm not really sure what to ask next." And of course, he asked me the tough question. Well, what question should I ask? I'm like, what have you read? I mean, it's like, you know, what questions did you already ask, so I can find which ones you don't know. So, but yeah, and there we go. That's that's so a good overview of at least 4 things to think about.
Yep. I think in the end, this is enough to really give you that initial answer to your question: is this manager in alignment with you when you look at an investment? And you should feel like, hey, you're the one in control of your own dollars. You're the one that's got the fund manager really saying, hey, I'm willing to make sure that I'm aligned and I'm doing the best for the investor. So, well, Chris, it's been great talking through all these things with you. Brittany.
Thank you.
Yes, you guys, thank you for joining us. If anyone has any questions now, you can add a question in the chat, or you can raise your hand. I'll see if we have any, or you can send separate messages to Chris or Brock.
One of the things that we can do is we'll send all of you a little bigger, what is it, the 8 keys or 8 areas where you should dive down and do some additional due diligence. We'll send out a link to all of you about that. It expands beyond a bit what we've covered today. And then you can always reach us at our link here, or both of our emails are there. Brittany?
Right, you guys, if we don't have any other questions or comments, thank you for joining us today, and we will see you at our next webinar.
Thanks for listening. Thanks, Brittany.
Take care, you guys.
Cheers.